I'm Charlotte McLeod with investingnews.com, and here today with me is John Rubino, who writes a popular newsletter on Substack. Thank you so much for being here. Great to have you.
Hey, Charlotte. Good to be back. Good to see you again.
Always good to be with you. And we're catching up from our last conversation all the way back at the end of 2025. So we've got a lot to go over. For the last couple of months, I think it's felt for gold and silver like we're going through the summer doldrums a bit, but prices have picked up in the last couple of weeks. So I wondered if we could start there and get your thoughts on what's driving those moves in the prices.
Well, gold and silver had phenomenal runs from 2024 through 2025, and then they corrected in 2026, which is totally to be expected. You don't get a big move like they had without some kind of a correction, because a big move creates so many profits to be protected and leads to a lot of selling. So we had that. And then we were in the summer doldrums, like you said. The weak time of the year for precious metals is usually the summer. And now we're in August, and we're leaving the summer doldrums and moving into the stronger seasonal part for precious metals, and they're starting to behave better. So far so good. Everything is behaving naturally in the precious metals market. And meanwhile, the mining companies are doing great. They're reporting excellent numbers. Their second quarter cash flow for a lot of them was almost as good as first quarter, which was just off the charts. And they're using a lot of the money that they're making now to improve themselves one way or another. So the mining industry is getting much more healthy. And the shares of the miners, since they've corrected along with gold and silver lately, look like they're in a good range for accumulation right now.
Lots of good topics there for us to follow down. Just to continue on the prices for a moment, I think many investors after the summer are wondering if this breakout in gold and silver is real, or if there could still be room for them to go lower. I know you said so far so good. Any further thoughts on that note?
Well, you can never tell what's going to happen in the next few months, because just about anything can happen externally to a market or internally with individual companies and things like that. So I wouldn't go out on a limb and say gold and silver have bottomed and they're going up from here, definitely. But it looks good. They're behaving well. And, the miners will tend to make a lot more money if gold and silver just stay where they are right now. That's all they have to do for the mining companies to get richer and richer and their stocks to be more and more attractive. So, yeah, there's no way to predict with any kind of certainty where we are, but I think in the short run, things look good. And in the longer run, things look great because the fundamentals that gave gold and silver their big run to begin with haven't changed at all. Every major government in the developed world is borrowing too much money, and the interest cost on their debt is starting to go parabolic. And they, in most cases, have no choice but to lower the value of their currencies. In other words, debase their currencies, engineer rising inflation in order to get out from under their debt. And that's an environment that's phenomenally good for gold and silver. So I think the basic fundamentals tell us that this correction that we've just seen was not the beginning of a new bear market, and it should be resolved in a bull market direction going forward.
Well, and on that note, I wonder if you can talk about the main gold and silver price drivers that you'll be watching as we continue on into the second half of the year. I'm seeing right now a lot of focus on the Fed, especially since we've got a new Fed chair at the helm there. And of course, there's also the war, which is still important, although it does seem to be maybe falling from attention a little bit as time goes on. So what will you be paying attention to most closely?
Yeah, the Iran war has disrupted a lot of different supply chains. And that kind of uncertainty, in other words, agriculture fails here and energy is disrupted over here. That's usually good for gold and silver just because the metals are places that we tend to hang out in when there's uncertainty otherwise in the world. What was the first thing you said before the war?
Also the Fed. Focus on the Fed.
Yeah, of course. Yeah. We have a new Fed chair here. And there was a job interview involved in him getting the job. And that interview involved the president or one of his surrogates saying, we need lower interest rates. You get that, right? And then the future chair of the Fed saying, "Of course, I'll give you lower interest rates." So the new Fed is coming in with a bias towards easing, and there are so many potential crises out there that even if they wanted to tighten, something is going to happen that forces them to ease. In other words, we'll have a trouble in the, for instance, private credit market, which is a bubble waiting to burst, and the AI market, which is an even bigger bubble waiting to burst. And when something like that happens, that affects the economy, which in turn leads to an equities bear market, which normally forces the Federal Reserve and the other central banks to start easing aggressively. So whatever the crisis is that we have in the next year, it's going to be something that the Fed is going to respond to with easier money. So I think there's virtually no doubt that within a year that we're in some kind of an easing cycle, and that even if the Fed would like to raise interest rates in the short run, it's not something they're going to be able to get away with longer term, just because so many things are potentially waiting to happen out there that's going to force the Fed to start easing.
This is going in a direction that I wanted to cover with you as well, which is, what is your take on the health of the U.S. economy right now? I think from everything you've been saying, we can tell that there are all these undercurrents under the surface waiting to come up and cause trouble. But what has allowed it to stay as it is for so long?
Well, the U.S. government is running massive deficits. We're running crisis level deficits right now, $2 to $2.5 trillion a year, and that involves the government just creating money out of thin air and dumping it into the economy. That's stimulative, and that's what we're seeing in large part right now. Is a lot of new money being created, given to people, given to the banks, and everything, and they're spending it. So we're getting growth, and we're also in the middle of a massive tech bubble. Huge amounts of capital are pouring into U.S. AI stocks. And, a lot of them are, they're starting to go public. You saw what happened with SpaceX just lately. They had the biggest IPO of all time. And they went from being a private company to one of the richest public companies ever. And we're going to see the AI companies go public pretty soon too. Now that creates a lot of capital gains, which people will then cash out of in one way or another and spend. And that's stimulative too. So you're seeing that stuff happen. But so much of it is derived from debt. We're borrowing huge amounts of money and we're spending it. And that makes it feel like we're rich. It creates an illusion of prosperity. But what it really means is that we have to pay off our debts at some point in the future, and we have to pay off the interest on our debt or cover the interest on our debt in the present. And that's already $1.5 trillion each year. We've got massive interest that is building up on the debt, which then has to build up even further to cover the interest, and so on. So something is probably going to happen in the not too distant future. You can't have this many bubbles and this many imbalances without some kind of a crisis happening somewhere, which leads to a crisis somewhere else, and so on. And the potential catalysts for the next financial crisis are so much bigger than they were last time around or the time before that. If you look at 2007, which had a pretty good, healthy economy, it seemed. And then by 2008, we were into the Great Recession. And that was just because of subprime mortgages, which was a few $100 billion. And that's all. And that was enough to destabilize the global economy. So now we've got a much bigger private credit market that, by the way, is already starting to kind of tip over. It saw huge inflows of capital for a few years, and now that capital inflow has dried up. So, that's one thing that can go wrong. And then, the Iran war's destabilization of a lot of different supply chains, that could be another catalyst. So there's no way to know what the catalyst is, but you can say with not certainty, but a high degree of likelihood that something bad is going to happen pretty soon, and it's going to leave the central banks of the world to start easing again. And so anyhow, long answer to the question of what should we do with gold and silver. We should continue to own it. They're going to do fine in a world that's taking on this much debt. And even though we can't know the details of how it plays out, it's borderline certain that precious metals are going to be in a good environment going forward.
I think that's so key to remember right now. And this is outside the US, but involving the US still. And I want to bring it up because it's something that we talked about in that last interview we did. You mentioned the yen carry trade, and it could be a big deal in 2026. And I've seen it making headlines again recently after that US Japan intervention. So I wondered if there's anything you'd like to update on there, the significance for the market of that.
That's true. I should have mentioned the yen carrying trade when we were talking about catalysts, things that could go wrong here, because basically the very short version of the Japan story is that they had a real estate bubble in the 1990s, but instead of taking the hit then, they chose to bail out everybody in sight, and they started building up massive government debt. And now the government debt on a per capita basis is higher than any other countries ever in history. And their interest rates are starting to go up as the bond market starts to worry about all the debt they're taking on, and the yen is starting to fall. And Japan owns a lot of U.S. Treasury bonds. So the U.S. government here just bailed out Japan by buying yen to prop up the value of the yen, so that Japan doesn't have to prop up the yen by selling a bunch of its treasuries and maybe spiking interest rates in the U.S. and causing a financial crisis here. So now you've got the two biggest debtors in the world bailing each other out, which doesn't sound like there's any problem with that, right? Yeah, what could go wrong? But the Japan issue is like the U.S. issue. They're not going to stop borrowing money anytime soon, and government debt in Japan is going to continue to increase. So we can bail out the yen in the short run and give it a nice quick spike. But the fundamentals are such that there's always going to be selling pressure on the currency of a country with this much debt. So there's really no fix for this problem. So this is going to be something that just looms out there for the U.S. Treasury bill market, or Treasury paper market, which is that one of the biggest owners of treasuries might be forced to sell those treasuries at any given time, causing interest rates to go up, yada, yada. We'll have a crisis at this end when Japan finally has to liquidate its treasuries to bail out its own currency. So, yeah, that's a thing that could happen. Could happen in the short run. Could happen a little bit further out. But either way, there has to be a reckoning for this much debt.
Well, again, building the case for owning gold and silver, and as you mentioned, the gold and silver stocks as well. So although prices are down from where they were at the beginning of the year, they're still high enough, like you were saying, to make it very profitable for the miners. So I wonder if you can share your thoughts on that. We're in the middle of earnings seasons right now. For investors, should they really focus on the big companies right now? Does that make the most sense at this time in the cycle?
Well, the big companies, they've had some corrections. So, the Agnico Eagles and the Barricks and the Franco Nevadas, they're all cheaper than they were. And they weren't really overvalued by most metrics before the correction. So yeah, you can definitely own the big guys in the mining space, and you will end up probably being quite happy with how it goes. But basically every layer of every different type of company in the mining space right now is interesting, because the big miners are making tons of free cash flow right now, but they're not replacing their reserves. In other words, they're mining more than they're discovering, and that's leading them to shrink in terms of production. They don't want that. So they're going to be on the lookout for, which junior miner they can buy that'll move the needle and make them grow again. And so there's going to be a lot of M&A in this industry going forward. And a lot of it is going to be at nice premiums. So some of the higher quality junior miners are likely to be bought out in the year ahead. And then we'll move further down the food chain until we're in the explorers space. And the higher quality explorers are takeover candidates too. So we should see a lot of the big guys buying out the smaller and much smaller guys in this industry. And that's that's kind of bittersweet, because if you own say an Explorer that you think is a 10 bagger, and Newmont comes in and buys it for 5 times its recent high, you made a lot of money, but you didn't make nearly as much as you would have if the thing had been allowed to play out to its logical conclusion, where it maybe builds its own mine and becomes a producer in its own right. So, we should be prepared to lose a lot of our really exciting little mining stocks to predation from the big guys, and that's just the way it goes, at least in the early part of a bull market. And later on, we'll reach the stage where anything with gold and silver in it is going to catch a bid from all the generalist money that's flowing into the sector. And so we'll see a lot of what we would consider now lower quality explorers, for instance, get bid up and actually become the best performers in the sector. Doesn't mean you should go out and buy them, because you should always focus on quality whenever you're buying anything. But it does mean that we'll be in that kind of amusing stretch at some point where names that really shouldn't be 5 baggers are just going straight up. But yeah, so that'll be fun when it happens, and risky, but also potentially profitable. We'll have more to talk about as that plays out.
Absolutely, absolutely. And I wonder, in the interim, is there anything that you look for when you're trying to identify these potential takeover targets? Because it sounds like it could be a real opportunity for investors.
Well, right now, you want size in terms of reserves, because the companies that are the most dramatically takeover targets for the big guys are the juniors and the explorers who have enough gold in the ground or silver in the ground to move the needle. In other words, who can make Agnico Eagle go from shrinking slightly to growing impressively. And there aren't that many of them. So in other words, potential tier 1 mines is what you're looking at. So those guys really have a target on their back right now. They're in danger of being bought out in the coming year. Hopefully at good premiums, but whatever. We'll see a lot of action in that space. But just in general, as Rick Rule likes to say, the problems for an emerging miner are the same whether they are big or small, but the potential gains are much more dramatic if they're big. So you want to go for size right now. And there's a lot of that out there. There are quite a few junior miners who have, production of 500,000 ounces of gold a year, and a lot of explorers who have potential tier 1 mines who, it's not a guarantee yet, but they're working on things that are that big. And we should be watching those and looking at them and trying to buy them opportunistically. Whenever there's a correction, you want to grab some shares like that.
Very helpful to see how you're approaching it there. I also want to bring up an interesting idea that you wrote about recently on your Substack. You're talking about how for the major miners, it could be interesting for them at this point in the cycle to be holding on to some of their gold and silver, which we don't really see companies do. I wonder if you could talk about the pros and cons of that strategy, whether you think we might actually see them start to do more of that.
Well, First Majestic, one of the big silver miners, just announced that in the second quarter, their inventories on hand of silver and gold went up dramatically, and they've got quite a bit of metal on hand right now. And that struck me as a good idea for all the miners, right? Because if you have faith in the product that you're selling, then holding on to some of it because you expect its price to go up in the future is totally reasonable. And if the industry as a whole started doing that, they would be adopting the physical ETF model, where you raise money, you go out and you buy physical gold and silver or whatever, you put it in a vault, and it stays there, and that takes the metal off the market, which, other things being equal, raises the price of it. So you get kind of a self-reinforcing feedback loop there, where the more you withhold from the market, the higher the price goes, and the higher the price, the more free cash flow you generate, which allows you to hold more and more metal off the market. So if the industry as a whole did that, I think it would be a much more healthy industry. It raises their risk level a little bit, but I think as a whole, it would be a smart thing for them to do.
Well, we'll have to see how that develops in the future. And as we're starting to wrap up on gold and silver, I wonder if you can sum up where you see them in the overall cycle. I know you mentioned we've got longer to go, bullish long term. How would you characterize it?
Well, yeah, we do have a ways to go because the world's fiat currencies are still functioning. They haven't been completely destroyed yet, and that's really part of the process. We've got to continue. Well, we don't have to, but we will continue to borrow huge amounts of new money, and that will force us to continue to inflate away our currencies until that becomes disorderly. And at that point, the big countries of the world will be forced to do some kind of a monetary reset. And gold and silver will be much higher when that happens. So, until that happens, gold and silver remain in a bull market. And I think the numbers that we'll start seeing for gold and silver will be dramatic compared to today's numbers. You could easily see $15,000 an ounce gold and $200 an ounce silver as this plays out. So the bull market doesn't stop until we start seeing real carnage in the currency market and dramatically higher prices in the precious metals market. So I'd say we've got years for this to run.
I think that's a great context on how you're looking at it. So we'll leave gold and silver there for now, but I also wanted to bring up copper. You were writing about that recently as well. And I think although it's been overshadowed a little bit by gold and silver this year, it's also a metal that's been making new highs. The price is on the rise at the moment. So can you talk about what's driving the increase in copper right now?
Yeah, while gold and silver were correcting pretty hard there, copper didn't blink. It just kept on going up, so that now it's right around its all-time high. And the reason for that is that the way the world is going implies that we're going to need a lot more copper. We're electrifying everything. Electric cars are replacing internal combustion engine cars, and all these AI data centers. Even though not all of them will be built, a lot of them will be built. And that requires more copper. And we're building out the grid in any event because we allowed the U.S. electric grid to get a little bit old and creaky and incapable of handling things like snowstorms and stuff like that. So in any event, we were going to have to build out the electrical grid and really upgrade it, which requires a lot more copper. So there's a stat going around in the industry that in effect, says we will need more copper in the next 30 years than we've mined in the first 10,000 years of human civilization. And there's nowhere near that much copper coming out of today's copper mines. So the price has to go up in order to incent more miners to go out there and find more copper. We're well into that process with copper having doubled in the last couple of years, but we're nowhere near the end of it. I think copper has to go up a lot from here before we generate anything like the new mining output that we're going to need. If it's even possible to do it, it's completely possible that we've picked all the low-hanging fruit in the copper market. And there just isn't that much copper available at any price, no matter what we pay the miners. And that just makes the price of copper go up even more. So I think that copper is a great story. And there are a lot of copper miners out there for us to pick from, and a lot of smaller ones coming online now. And there's also there's at least one physical ETF out there. So there's a lot of ways to play copper. And all of them probably work out in the long run.
Well, and very interesting. So you, in your article, added another piece to the copper story that I wasn't as familiar with or haven't really heard discussed as much. So we know that we've got the positive supply and demand fundamentals, but you mentioned also this new theme of countries trying to keep the copper that they mine kind of within their borders. So I wonder if you can speak about that and the significance of that development.
Yeah, copper has become a national security issue for a lot of different countries where they know they're going to need it. They know they can't run a modern economy and a modern military without it. So they're not exporting it anymore. They're just what they get, they're keeping. And that's happening for some mining countries that want to stockpile because they assume the price is going to go up, and it's happening for a lot of copper users who know they're going to need it, and they don't want to let it go. They want to buy it and keep it. And yeah, so now you've got the public sector behind the copper price. In other words, the military. And a lot of industrial uses that aren't military right now require so much copper that these guys aren't price sensitive anymore. They know how much copper they need, and they're willing to pay whatever it takes to get it. So you're seeing that with gold and to an extent silver in central bank buying for monetary reserves, and for industrial reserves. You're seeing a lot of that in the copper space and a lot of other commodities. So yeah, that's going to be a big story going forward. Which governments have decided that they want to prop up which commodities? And we have to remember governments have unlimited printing presses. So whatever they have to pay, they're able to pay it with money created out of thin air. And that only points towards higher copper prices for sure.
Yeah, you can really see that critical minerals type of angle developing for copper. So great to go into that as well. I wanted to ask for the copper companies, have their share prices been responding to the price action that we've seen this year? How's it looking?
Some of the junior copper miners have just rocked. They've been up 5 to 7 times in the last couple of years, and the bigger copper miners are doing okay. But they aren't behaving like potential five baggers or anything. And I think that is an entry point. That's an acquisition opportunity for a lot of these things because they're going to make a lot of money going forward. They've got the same dynamic as gold and silver, where they're going to generate a lot of free cash flow, and they're going to use that cash flow to improve themselves. The big guys aren't. They haven't behaved in an exciting way, but I think that's out there waiting to happen for them. And for to the extent that you can do the research, if somebody can tell a high quality junior copper miner from a mid-range one, and separate the wheat from the chaff in that way, I think there's a lot of opportunities in the copper space because there are a lot of little stocks that nobody knows about right now. And if we can find them and pick the best of them, there's a lot of money to be made.
Yeah, that's a good direction to go in as well. I always feel a little bit unsure of how to approach copper from the company angle, just because the timelines, as you're talking about, they are so long in the mining sector, and it seems like especially so for copper. So, we've got this long-term copper timeline. Does it make sense to go for a junior right now or to look at the big ones? Any further thoughts you'd add on that note?
Well, I think it depends on your understanding of the mining business. If you're new to the business, buy an ETF that just owns all the miners in the junior space or the senior space. And as you educate yourself and you get smarter, then you can work your way down to the mid tiers and the explorers. But you don't want to do that without an understanding of what it is you're buying. So start with the stuff you can understand and then learn. And the more you learn, the bigger risks you can take and the more potential money you can make.
I think that's a great principle to apply. And as we're getting to the end here, I wonder if there are any final thoughts that you would share with investors, points that you're watching that we didn't cover.
Well, I think we should keep in mind that a lot of the gloom and doom stuff that we tend to talk about, giant financial crisis coming, et cetera, that can be really scary for a lot of people. And it's, if you can do it, better to keep in mind that all of these potential crises that are out there also form an investment thesis. In other words, they give you a scenario in which you can make a lot of money by allocating capital in the right way. And that's a happier way of looking at all of this. Okay, the turmoil is coming. Strange times are coming. But it's possible, if we play it right, that we can protect our family and enrich ourselves and come out of this in better shape than we would have otherwise. So, I think that's a better psychological way of approaching this, instead of the kind of crisis investing where you're just piling up all the bad things that can happen. And sometimes that's terrifying.
Well, very nice way to reframe it. And I think a good way as well to wrap it up for today. So thank you so much for coming on to talk about gold, silver, copper, the markets. As always, this was really valuable.
Thanks, Charlotte. See ya.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is John Rubino.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.